Good day, Junior Tickies. I'm Mrs. Brimacombe. We're going to look now at Activity 7. The information provided was extracted from the financial statements of Best Furniture. The business is owned by Naidu and Mens. 7.1. Calculate the following indicators for the year ended 2022. Question 7.2. Comment on the return on owner's equity as a business and the percentage return by Naidu. 7.3. The partners increased their capital by 100,000 each. How did this affect the gearing and risk of the business? Quote financial indicators to support your answer. 7.4. Comment on the following indicators. Note, the intended markup is 120% on cost of sales. Quote figures to support your answer. And 7.5, consider the working capital indicators. Have these items been efficiently controlled or not? The information they provided us with an extract from the Statement of Comprehensive Income for the year ended 30 June 2022, and then an extract from the Statement of Financial Position. Information C, financial indicators for 2022 and 2021, and then they gave us additional information. Starting with question 7.1. Calculate the following indicators for the year ended 2022. So first we need to calculate the percentage net profit on sales. To calculate the percentage net profit on sales, we need the sales figure, which was given to us in the Statement of Comprehensive Income. But now we need to find out what is the net profit. So if we look at the additional information which was given to you, partner Naidu earned a total of 102,400 and partner Mens 93,000 for the year ended 30 June 2022. So to find out the net profit, we are going to add what each one of them earned together. Make sure that you understand that your partner's earnings is your primary distributions of profits plus the final distributions of profits. So this is why we're going to add them together to find out what was the net profit. Once we've calculated the net profit, we can take the net profit divided by sales times 100, so the percentage is 11.2%. 7.1.2, the stock holding period. Now to calculate the stock holding period, we need our cost of sales and we need our average inventories. On my Statement of Financial Position, inventories, they provided to you 30 June 2022 and 30 June 2021. To calculate the average stock, we need to take the beginning plus end divided by 2. Then, once we've got the average stock, we're going to divide it by the cost of sales times 365 days. That means that my stock holding period is 77.2 days. Asset test ratio. To calculate the asset test ratio, you've got two options. It's either your current assets minus inventories divided by your current liabilities, or you're going to take your trade and other receivables plus your cash and cash equivalents divided by your current liabilities. So it all depends on how the information is given to you. If we look at how it was given here, they provided the current assets and they provided the inventories. So we're going to take the current assets minus inventories divided by the current liabilities. It's in a ratio, so the ratio should always be 2:1. So take 378,850 divided by 305,000. To calculate the debt-equity ratio, it's your non-current liabilities divided by your partner's equity. So if we look at the Statement of Financial Position, non-current liabilities is 540,000. Then the owner's equity, they've already done the calculation. So use the 706,000. So take the non-current, which is 540,000, divided by 706,000. The ratio is always to 1. So this equals 0.8 to 1. Percentage return earned by Naidu on her average equity. So we need to know what was her earnings. Partner Naidu earned a total of 102,400. We need to divide it by her equity in the business. And what does your equity consist out of? Your capital plus a current account if the form of ownership is a partnership. So to calculate this, we start with the partner's earnings, 102,400. Then we need to take the average equity, which is the beginning plus end divided by 2. Now, when you look at your current account, if it's a negative, it means it must be subtracted. So we had 400,000 Naidu, her capital in 2022, minus current account 12,000 in 2022. For 30 June 2021, the capital was 300,000 and the current account was 3,000. So, because we want to know the percentage return, this must always be times 100. Now we can take the net profit divided by the average equity times 100 equals 29.6%. 7.2. Comment on the return on owner's equity as a business and the percentage return by Naidu. When we're looking at our return financial indicators, we want to know what was the percentage return on the owner's investment into the business. And this must always be compared to alternative investments like a fixed deposit. So if we start now by looking at the business, we're going to use the percentage return earned on business equity. You need to make sure that you quote the figures and indicate a trend. So what is happening here? The percentage return decreased from 27% in 2021 to 22% in 2022. Although there's a decrease in the percentage return earned by the business, if we compare this to alternative investments, it is still better. They provided to you money can be invested at 10.5% interest per annum. Use that percentage indicated in the information when you are commenting and you're comparing this to alternative investments. If we're looking at partner Naidu, the percentage return needed to be calculated. So we calculated it in question 7.1.5. Again, you need to make sure any calculations which was done with financial indicators, attempt it at least, write something. Because if you leave it out blank, then you will not be able to answer this question. Because what are you going to compare the percentage return earned by Naidu in 2021? What are you going to compare it to if you haven't done any calculation in 7.1.5? Now, when we're commenting, we're now comparing last year with this year. Last year, his percentage or her percentage return was 24%. It increased from 24% to 29.6% in 2022. Not only that this increase, but this is also better than alternative investments at 10.5% at a fixed deposit. So Naidu should be satisfied with her return. 7.3, the partner's increase their capital by 100,000 each. How did this affect the gearing and risk of the business? Quote financial indicators to support the answer. So when we're looking at capital contribution and you see the words loan, should we take out an additional loan or not? When you see the words gearing and risk, you should know that the financial indicator applicable is your debt equity ratio. When we're looking at the debt equity ratio, we need to compare last year with this year. This year had a question mark. We needed to calculate that in question 7.1.4. So how do we comment now on this? We start by indicating the financial indicator, and we need to calculate the debt equity ratio, which we've done now in 7.1.4. When we're commenting now, we compare last year with this year. Last year, the debt equity ratio was 1,2 to 1. It decreased from 1,2 to 1 in 2021 to 0,8 to 1 in 2022. The business has a moderate to high financial risk. But if we look at last year they were more reliant on borrowed capital than owned capital, whereas compared to this year, they are now more reliant on owned capital than borrowed capital. But it's still a moderate to high financial risk if we're looking at 0,8 to 1. The business, as I've said earlier, is more reliant on owned capital than borrowed capital. Now, if we look at the cost of borrowing money, the cost of borrowing money is 21%. It's indicated there in brackets. Should the business opt to take out an additional loan of 200,000? The cost of borrowing money will increase, which will affect our net profit, and the debt equity ratio would have been 1,4 to 1. If you take 540,000 and you plus 200,000 divided by your owner's equity, 506,000 now, because this means instead of the partners contributing 100,000 each, we opted to borrow an additional 200,000. So this would have increased our financial risk. It would have gone up from 1,2 to 1 to 1,4 to 1. So the current percentage return earned by the business is 22%, and the interest on loan is 21%. If the interest goes up, then this will not be favorable. This is why the partners made a good decision in contributing additional capital than borrowing money from the bank. So just to recap, what are we doing here? We're first looking at the debt equity ratio. We compare last year with this year. We indicate what is our financial risk. Do we have a high, low, or moderate financial risk? Now, in this calculation, if we compare last year with this year, it decreased. The business is more reliant on owned capital than borrowed capital. Remember, the question is, was it a good decision for the partners to increase their capital? How did that affect the gearing and risk? So if we look at if the partners decided to rather opted for borrowing additional money, then their owner's equity would have been 506,000 and the non-current liabilities would increase to 740,000. This means that their financial risk would even be higher. And then another thing that we look at, what is the cost of borrowing money compared to what was the percentage return that they're getting? And this is why we concluded now that it was actually a better decision to contribute additional capital than to borrow more money, for example. 7.4, comment on the following indicators. Note that the intended markup is 120% on cost of sales, quote figures to support your answer. The first one is gross profit on cost of sales. The percentage have improved from 100% to 115%. Although the percentage improved by 15%, the business did not achieve the end markup of 120%. This could be due to trade discounts allowed to bulk buyers, stock was discounted during the sale or during a sale, errors in calculating the markup. If we're looking at the operating expenses on turnover, the percentage decreased or improved from 39% to 36% in 2022. Now, you would expect your expenses to go up, but in this case, the expenses went actually down. This means that the business has done well to control their operating expenses. 7.5. Consider the working capital indicators. Have these items been efficiently controlled or not? When we're talking about the working capital, we're looking at our liquidity financial indicators. Make sure that you understand the terminology. Know what is your options. You've got 6 options, but it doesn't mean all of them can just be written down and used. It depends on the information which is given to you. So if we're looking at the first one, the current ratio, it improved from 2,9 to 2,3. Remember when we did the current ratio, the liquidity financial indicator, we said that this current ratio can also be too high. So if it went from 2,9 to 1 to 2,3 to 1, that is actually better. The business can use the excess cash to generate additional income. Our next option is our asset test ratio. If we compare last year with this year, the asset test ratio decreased from 1,5 to 1 to 1,3 to 1. So if it decreased, it's actually also an improvement. Less money is tied up in trading stock. I'm making a slight change there. Say the asset test ratio decreased from 1,5 to 1 in 2021 to 1,3 to 1 in 2022. Identify the words increased or decreased and quote the figures. The next financial indicator which we can use is the average debtors collection period. It improved from 55 days to 33.2 days. Or you can say the debtors collection period decreased from 55 days to 33.2 days. But you need to realize if the debtors collection period decreases, that is an improvement. And if we look at the information which was given, the additional information, the debtors payment period is 30 days as per credit policy. So that is much closer to our credit policy than the 55 days. So indicate the financial indicator, quote the figures, and give an opinion. The debtors are better controlled and is much closer to our credit policy of 30 days. Our next option is the stock holding period. If we're looking at the stock holding period, last year it was 82 days. This year it is 77.2 days. So it decreased from 82 days in 2021 to 77.2 days in 2022. A decrease in your stock holding period means that is an improvement. We are selling our stock quicker. We're keeping it for less amount of time in the business. I'm going to remind you, make sure that you study your financial indicators. A formula sheet will be provided, but that doesn't help a lot. You need to understand your financial indicators and where does it fit in. Remember when we started with the first activity, we said we're looking at the following questions. Is the business profitable? How well is the business managing their expenses? Is the business solvent? What is our liquidity position? Are we able to meet our short-term obligations? What is the owner's return on their investment? What is our financial risk? Those are questions that we need to answer by looking at the financial indicators. When we're analyzing our income statement or statement of comprehensive income and our statement of financial position, we need to analyze that information in the form of financial indicators, and then we comment on that. The more you practice this section, especially with the commenting, the better you will get at it. And the guarantee marks, the easy part in this is knowing which financial indicators to use when and how to calculate it. I understand that the commenting can sometimes be a bit more challenging, but there's the easy section, which if you just study your financial indicators, you can get it right. The more you practice how to comment, the better you will get at it. As long as you always keep the following in mind. Quote your figures, indicate the trend, and give an opinion based on that. I want to leave you with this quote. You have brains in your head, you have feet in your shoes, you can steer yourself in any direction you choose. Have a wonderful day.